Welcome back to Report of Silver, where we break down the biggest stories in gold, silver, and the global financial system so you can understand what is really happening beneath the headlines. Today we are tackling one of the most important questions in precious metals investing. Why do so many people lose money stacking silver, while others build real long-term wealth from it? The answer may surprise you, because it has very little to do with the price itself and everything to do with mindset. If you are new to silver, or even if you have been stacking for years, this is a video you need to hear all the way through, because it may completely change how you look at your stack. Before we begin, make sure you subscribe to the channel, hit the like button, and share your thoughts in the comments below. I post daily updates on silver and gold, so you can stay ahead of the curve, not behind it. Most people who get into silver make one critical mistake right from the beginning.
They enter this market believing silver is some kind of quick money opportunity. They think silver is going to double overnight, they imagine instant profits, and they treat it like a lottery ticket instead of what it actually is. Silver is not a get-rich-quick scheme. It never was. It is not supposed to behave like a meme stock, and it is certainly not supposed to act like a cryptocurrency that explodes upward in a matter of days. Silver is a long-term wealth preservation tool. It is financial insurance. It is protection against a system that has consistently devalued currencies for generations. But many people do not understand that when they first enter this market, and because of that misunderstanding, they panic. They buy silver when excitement is high. They buy when everyone on social media is talking about it. They buy because they see a rising price chart and assume it will continue forever. Then the moment silver pulls back, which it always does because silver is naturally volatile, fear begins to take over. Suddenly they are checking the price every hour. They refresh their apps 10 times a day. They start asking themselves whether they made a mistake. The emotional attachment becomes overwhelming, and that is when bad decisions happen. They sell at exactly the wrong moment. That is why I always say invest with your head, not your heart. Emotion destroys portfolios. Emotion creates panic sellers. Emotion convinces people to abandon good assets simply because they are not moving on their preferred timeline. But experienced silver stackers understand something very different. They understand that silver's true value is not found in a fiat price quote on a screen. It is not defined by what a dollar says it is worth today. Silver's value comes from what it is. Silver is one of the most important metals on Earth. It is the most electrically conductive metal known to man. It is the most thermally conductive metal. It is essential in electronics, solar panels, electric vehicles, medical devices, military systems, and advanced technology. There are entire industries that literally cannot function without silver. That alone should make you stop and think. This is not just another commodity. This is a strategic metal with real-world necessity. And yet, despite all of that, silver remains misunderstood. Many people compare it to gold and ask why silver instead of gold. Gold is wonderful. Gold is money. Gold has protected wealth for thousands of years. But silver is different. Silver gives you monetary protection, yes, but it also gives you industrial demand. It gives you a dual purpose. It is both a monetary metal and an industrial metal. That combination is what makes silver so powerful. This is also why many serious silver investors are calm even when prices fall. They understand that the market price is temporary, but the intrinsic value remains. A paper market can misprice silver for months or even years, but it cannot erase silver's usefulness. It cannot erase the structural deficits. It cannot erase rising global demand. And it cannot erase the fact that physical silver remains one of the most undervalued strategic assets in the world today. That mindset is what separates speculators from true stackers. A speculator asks, "What is silver doing today?" A stacker asks, "What will silver mean 10 years from now?" That is the difference. And once you understand that difference, you stop fearing price drops and start seeing opportunity instead. As soon as you begin to understand silver from that perspective, something changes mentally. You stop seeing red days as losses, and you start seeing them as opportunities. You stop obsessing over the daily spot price, and instead you begin focusing on ounces accumulated. That is one of the most important transitions a silver investor can make. It is the moment when someone stops behaving like a trader and starts behaving like a true wealth preserver. And that mindset matters because history has repeatedly shown us that fiat currencies fail, but real money endures. Think about this for a moment. In 1965, the United States stopped circulating 90% silver coins as everyday money. Before that, your dimes, quarters, and half dollars contained real silver. If you had taken a 1-ounce silver coin back then and simply stored it away, doing absolutely nothing, that same ounce today would still hold purchasing power. In fact, it would have dramatically increased in nominal dollar terms because the dollar itself has weakened over time. Meanwhile, if you had simply held onto a paper bill, that bill would have lost the overwhelming majority of its purchasing power due to inflation. This is what people fail to understand. Silver is not designed to make you rich overnight. It is designed to preserve the wealth you have already earned. That is why I often describe silver as a time capsule for your money. It allows you to store labor, energy, and purchasing power outside of the traditional banking system. It protects your savings from inflation, monetary policy mistakes, reckless government spending, and currency debasement. Every single year, central banks around the world create more currency units, more dollars, more euros, more yen, more pounds. They can print currency endlessly, but they cannot print silver. Silver must be mined, refined, and physically extracted from the earth. That scarcity matters, and this is where many new investors go wrong. They jump into silver without understanding that purpose. They treat it like a short-term speculation vehicle. We saw this very clearly during the Wall Street silver movement in early 2021. Suddenly, everyone wanted silver. Social media was exploding. Retail investors rushed in. People who had never cared about precious metals were suddenly buying silver because it was trending. Some came from the meme stock crowd. Others came from crypto. They saw silver as the next hot trade. But what happened? Silver moved toward $30, excitement surged, and then the market pulled back. Immediately panic set in. Many of those same buyers sold. They exited the market frustrated and disappointed. Why? Because they never understood what they were buying in the first place. They thought they were buying momentum. They thought they were buying hype. They were not buying silver as wealth insurance. They were gambling. That is a very important distinction. Investing and gambling are not the same thing. Gambling is buying something because you hope someone else will pay more for it tomorrow. Investing is buying something because you understand its long-term value. That is why many people buy assets at all-time highs and then panic when prices fall. It happens in stocks. It happens in crypto. And it absolutely happens in silver. Human psychology does not change. Now think back to March of 2020. Silver collapsed to around $11 an ounce during the global market panic. At that moment, almost nobody wanted it. Investors were terrified. Headlines were negative. The crowd believed silver was broken. But what happened afterward? Silver exploded higher. That was one of the greatest buying opportunities in recent history, and most people missed it because fear blinded them. This is why understanding silver matters so much. Less than 1% of the global population owns meaningful amounts of physical silver. Let that sink in. We are still extremely early. There is not enough investment-grade silver in the world for every person on Earth to own even a single ounce. That alone should tell you how scarce this asset truly is. Yet because the paper market can push prices around in the short term, many people never recognize the opportunity sitting in front of them. The people who succeed in silver are not the ones chasing headlines. They are the ones quietly accumulating over time. They understand volatility is normal. They understand manipulation exists. They understand markets can remain irrational for longer than expected. But they also understand that physical ownership removes counterparty risk and preserves optionality. In simple terms, they sleep better because they own something real. That is what stacking is really about. It is not about excitement. It is about security. Now that we understand the mindset behind successful silver stacking, we have to address the biggest question people always ask. If silver is so valuable, why does the price often seem disconnected from reality? Why can something so strategically important, so necessary to modern industry, trade at levels that appear completely irrational? This is where understanding the disconnect between the paper market and the physical market becomes essential. Most people look at the silver price on their phone and assume that number represents silver's true value. It does not. What they are looking at is largely the paper price of silver. That price is determined primarily through futures markets like COMEX, where contracts representing silver are traded in enormous quantities every single day. These contracts often represent silver that never changes hands physically. They are financial instruments, not necessarily physical deliveries. That distinction matters more than most investors realize. In these paper markets, silver can be sold in massive amounts with the click of a button. Institutions can create enormous downward pressure simply by selling futures contracts, even if no physical silver is actually being moved. This creates what many analysts call price suppression or price distortion. Whether you want to call it manipulation, leverage, or structural imbalance, the effect is the same. The spot price often reflects financial pressure rather than true physical scarcity. This is exactly why the phrase "price is the greatest tool of misdirection" is so powerful. When silver drops sharply, many people assume demand has disappeared. They assume something must be fundamentally wrong, but often that is not what is happening at all. What is actually happening is liquidity pressure. Let me explain. When markets become stressed, large institutions do not always sell what they want to sell. They sell what they can sell. Silver is highly liquid. It is widely owned. It is easy to convert into cash quickly. So when margin calls hit or volatility rises, silver often becomes a source of immediate liquidity. Funds sell it to raise cash. That selling pushes the price down, but it does not mean silver suddenly became less valuable. It simply means the system needed dollars in that moment. We saw this happen in global financial crisis. Precious metals sold off alongside equities before recovering strongly. We saw it again during the COVID-19 market crash. when silver briefly collapsed toward $11 an ounce before exploding higher in the months that followed. The pattern repeats because market structure repeats. But here is what makes today different. The demand underneath silver is becoming increasingly structural, not cyclical. This is not just jewelry demand or investor demand anymore. Silver has become embedded in the global industrial system. Solar panels require it. Electric vehicles use it. Electronics need it. Medical devices depend on it. Military systems rely on it. Even governments are beginning to classify silver as a strategic or critical mineral because of national security concerns. At the same time, supply is becoming less flexible. Most silver is not mined as a primary metal. It is a byproduct of mining for metals like copper, lead, and zinc. That means silver production cannot simply ramp up because the silver price rises. The supply response is slow. It is constrained. That creates a structural bottleneck. Now add geopolitics to the equation. Countries are increasingly treating critical resources as strategic assets. Export controls are tightening. Nations are prioritizing domestic access to raw materials. We have already seen how quickly supply chains can break when governments intervene. Silver is not immune to that. In fact, because it is both monetary and industrial, it may be more exposed than most commodities. So what happens? The paper price may move lower because of financial market stress, while the physical fundamentals become stronger underneath. That is the disconnect. Short-term price is driven by liquidity. Long-term value is driven by structural demand and constrained supply. Those are two completely different forces. This is where inexperienced investors get confused. They look only at the chart. They see a falling price and assume silver is weak. But sophisticated investors ask a different question. Who is buying during this weakness? Historically, it is often the largest and smartest players. Central banks accumulate gold during weakness. Billionaires buy hard assets during weakness. Industrial users lock in supply during weakness. They understand what the crowd often misses. Temporary price declines do not erase long-term value. Sometimes they reveal it. Once you understand that disconnect between paper pricing and physical reality, the next logical question becomes even more important. If the market is misreading silver, who actually understands what is happening? Who is quietly positioning while the average investor is distracted by daily price swings? The answer, historically, is the same group every single time. The largest players in the room. Watch what governments do, not what they say. Watch what institutions accumulate, not what they publicly advertise. Watch what industrial buyers secure during moments of weakness. That is where the real story usually lives. Retail investors often react emotionally. Big players usually act strategically. Take global demand trends as an example. While many retail investors panic during price corrections, industrial demand does not disappear. A solar manufacturer does not suddenly stop needing silver because the price chart turned red. An electronics company does not redesign an entire product line overnight because silver dropped $10. A military contractor does not abandon silver because futures traders had a volatile week. Their need remains. In fact, lower prices often encourage greater procurement because it allows them to secure future supply more cheaply. This is why physical demand can remain extremely strong even while the paper market appears weak. It confuses new investors because they assume lower price means lower demand. In reality, the opposite can often be true. Lower prices can trigger stronger physical buying. We have seen that repeatedly in bullion markets worldwide. Coin dealers report surging demand. Premiums rise. Delivery delays appear. Yet the headline price remains under pressure. That is the disconnect in action. Then there is the supply side, and this is where things become even more interesting. Silver mining is not simple. It is not instant. You cannot just decide to double silver production because prices rise. Mining projects take years to develop. Permitting takes time. Infrastructure takes capital. Labor costs increase. Energy costs rise. Environmental regulations tighten. And remember, much of global silver output comes as a byproduct from other mining operations. That means supply growth is structurally slow. That creates a very important imbalance. Demand can accelerate much faster than supply can respond. And when that happens, deficits begin to build. We have already seen this in recent years, with multiple consecutive years of silver deficits globally. More silver is being consumed than newly produced. That cannot continue forever, without consequences. This is why serious investors focus on ounces, not daily prices. They understand that every ounce accumulated today may become significantly more difficult to obtain tomorrow. That does not mean silver will move in a straight line upward. It never does. Silver is volatile by nature. It is emotional. It moves aggressively in both directions, but long-term fundamentals matter. Now let us talk about miners, because mining companies sit right in the middle of this dynamic. Their short-term performance often tracks the silver price, which means they can be punished heavily during liquidity events. But unlike paper traders, miners are tied to physical assets in the ground. Their reserves do not disappear because the market panics. Their ounces do not vanish because a hedge fund needed cash. The metal is still there. This is why quality miners often survive downturns and thrive in recoveries. The best operators understand discipline. They focus on costs. They protect balance sheets. They prepare for volatility instead of assuming endless bull markets. And when the cycle turns, they are positioned to benefit disproportionately. But this entire discussion leads to a deeper truth. Silver is not just an investment. It is not just a commodity. It is a form of optionality. It gives you choices. It gives you independence. It gives you exposure to a real asset outside the traditional financial system. That matters today more than ever because trust in institutions continues to decline. People are watching inflation erode savings. They are watching governments increase debt endlessly. They are watching banking systems become more digitized, more centralized, and more controlled. In that environment, owning physical silver is not simply about making money. It is about maintaining sovereignty. That is why true stackers do not panic when prices fall. They understand what they own. They understand why they own it. And because of that, they remain calm while others become emotional. That mindset is where long-term success begins. As we close today's discussion, I want to leave you with the most important lesson in all of silver investing. And honestly, this may be the lesson that determines whether you succeed in this market or whether you become another person who gives up too early. Silver rewards patience. It rewards conviction. And most importantly, it rewards understanding. If you buy silver, hoping for instant gratification, you will almost certainly become frustrated. There will be weeks when nothing happens. There will be months where it feels like silver is stuck. There will even be moments when silver drops sharply and every headline around you tells you that you made the wrong decision. Those are the moments that test investors. Those are the moments that separate emotional participants from disciplined stackers. The truth is, silver has always moved in cycles. It does not ask for permission, and it does not move according to anyone's personal timeline. It can remain undervalued longer than most people expect, but when it moves, it tends to move violently. That is why people who chase price often miss the real opportunity. They enter too late because excitement pulls them in, and they exit too early because fear pushes them out. They buy high and sell low, which is exactly backwards. The successful silver stacker does the opposite. They buy during uncertainty. They accumulate during weakness. They understand that short-term price action is often noise, but long-term fundamentals are what matter. They recognize that silver is one of the few assets in the world that offers both monetary protection and industrial necessity. That combination is rare. It gives silver a unique role in a modern portfolio. Think about the world we are moving into. Debt levels are exploding globally. Governments continue to print currency at extraordinary rates. Inflation has permanently changed how people think about money. Banking systems are becoming more digitized, more centralized, and increasingly more monitored. Around the world, people are waking up to the fact that financial freedom requires ownership of assets outside the system. That is where physical silver comes in. Silver does not need a password. It does not require a banking app. It cannot be frozen by a financial institution. It cannot be diluted by a central bank. It cannot be hacked. It simply exists physically in your possession. That kind of financial independence is becoming more valuable every single year. And then there is the supply story. We continue to see structural deficits, industrial demand continues rising. Governments increasingly recognize silver as a strategic resource. The green energy transition depends on it, military applications depend on it, advanced electronics depend on it, medicine depends on it. Yet despite all of that, most of the world still does not own it. That is what makes this moment so remarkable. We are still early. That does not mean silver will rise every day. It does not mean there will not be volatility. There absolutely will be, but volatility is not the enemy. Misunderstanding is the enemy. If you understand what silver is, why it matters, and why you own it, then short-term price drops become much easier to tolerate. In fact, they often become opportunities. That is why I always tell people, stop measuring your silver in dollars. Start measuring your dollars in silver. That mental shift changes everything. Suddenly, you are not worried about temporary fluctuations. You are focused on preserving purchasing power. You are focused on protecting your family. You are focused on building long-term resilience. That is what stacking is really about. It is not about hype. It is not about emotion. It is not about chasing the next trend. It is about preparation. It is about discipline. It is about owning something real in a world increasingly built on financial promises. Thank you for joining me today here on Report of Silver. If you found value in this analysis, make sure you subscribe, hit the like button, and share this video with someone who needs to understand what silver really is before they invest in it. And in the comments below, I want to ask you one question. What made you start stacking silver? Was it inflation, distrust in the banking system, long-term wealth preservation, or something else entirely? Let me know. Until next time, stay informed, stay prepared, and keep stacking.